Everyone, let's understand the concept of transfer pricing, which is an enjoyable, interesting concept in international taxation. Okay, for now it has been planned for around 2 hours. Let's see how it works. Okay, transfer pricing provisions have been brought in with a view to provide a statutory framework which can lead to computation of reasonable, fair, equitable profits and tax in India in case of such multinational enterprises. For example, this clearly states that transfer pricing provision is applicable only in case of multinational enterprises in order to establish fair and equitable profits and tax in India. So, for example, an Indian company has a tax rate of 30%, while Nepal company has a tax of 10%. So, the entity company would generally be involved in profit shifting from India to Nepal entity, resulting in a tax saving of 20% to the entity. For example, if an Indian company has an income of 100 rupees, then while it has to pay a tax of 30 rupees, while for a similar income of 100 rupees in Nepal, it has to pay only 10% tax. So, by increasing the revenue in Nepal company where there is lower tax, and by increasing the expense in Indian company where there is higher tax, it could reduce its tax burden. Okay, this is commonly known as tax evasion. Okay, in transfer pricing we deal with such cases where there is a manipulation of price charges or paid at in such intragroup transactions which may lead to erosion of tax revenue. So this transfer pricing provision is applicable only when there are transactions between two associated enterprise in order to determine the correct transaction price. We'll learn all these key terms. Okay, what are the key terms here? Associated enterprise. It is dealt in section 92A, which has prescribed 13 conditions, mostly either or conditions. And then what are transactions covered within the purview of transfer pricing? It could either be an international transaction or it could be a specified domestic transaction. Okay, then what is the correct price? Correct price is that price which has been determined using the arm's length price principle. So now we have a question, right? How do we calculate ALP? It has been laid out in three different sections. Okay, the process related to this. One is section 92C, which gives us five method, which is CUP, RPM, CPM, PSL, TNM. We'll discuss all these on the coming few minutes. Okay, and then if in some cases what happens is that I am not able to determine the ALP, or the assessing officer feels that the ALP computed by the entity is not proper, so the AO himself will determine the ALP using the powers conferred to him with the in section 92C subsection 3. Okay. The next section would be section 92CA, where it states that we could refer the transfer pricing case to a transfer pricing officer. And then we have section 92CC, where the decision of price is made in advance using APA, that is advanced pricing agreement. How do we understand it? Generally, in a family, whenever we have some issue, whom do we approach first? It is our father, right? Appa. Okay. Similarly, in the case of transfer pricing, we don't know what to do. Okay. So what we do is, please let us know. We just go to APA, that is Advanced Pricing Agreement bench, and say, please let us know what the price we have to charge, so that we need not want to be in the non-compliance zone. Okay. So generally, whatever the order is being passed by using the APA is valid for 5 years. It can also be valid for some certain number of period within 5 years. That is, it could be valid just for 3 years or some cases. Okay. Maximum period for which an advance pricing agreement could be passed is 5 years. Okay. We can also use the similar provisions to be applied to determine the ALP for immediately preceding 4 years. So, towards the forward, it could be for 5 years, while if we have to roll back, then it is 4 years. That is called as rollback provisions. Okay. Now, we have calculated ALP, but we have more than ALP. So what do we have to do? What happened is, I have similar customers. Okay, I have one intra-group company, let's say for ABC Inc. Okay, but I have also some other export customers. So in for automatic ALP, I've also all used that uncontrolled price of all these. Okay, so I have more than one ALP. What should I do? The provision states that check if you have the number of ALPs less than six. If it is less than six, no worries. So you can use arithmetic mean. Section 92C subsection 2. If number of ALP is more than 6, then use the range concept which is given under rule 10CA. Okay, we'll all discuss this later. Okay, it's just an overview of what are going to be discussed. Okay, yeah. Now, moving on to next is, now we have ALP calculation, either the arithmetic mean or the range concept. Okay. Now we have the ALP so determined with the actual price and arrive at the difference. You have to compare the ALP and arrive at the difference. If, for example, I have sold some goods at rupees 100 to Nepal entity. Okay, but the arm's length price of such sales is 150. So the arm's length price is more than the actual selling price, then added to the income and ask the HSC to adjust his books of accounts. Okay, so it could either be a primary adjustment or it could be a secondary adjustment. Okay, in both cases, there would be some excess money, right? 50 rupees in our case is the excess money. This excess money has to be repatriated back into India. Okay. I see that I can't get the money back and all. What should I do? Is there any option? Now they tell that if the excess money can't be repatriated, then we have two given you two options. Okay, we are asking what are the two options in case of non-repatriation of funds. He says that it would be treated as an advanced associated enterprise, so you have to add income on such advances while computing the GTI till, okay, it says that till you receive the funds back to India, you have to treat it as loan given to the associated enterprise or advance given to the associated enterprise, and you have to charge interest on that. And such interest will be added to your gross total income while computing the taxes. Okay, as you say, you for every year I have to add this, still I get it back. I don't know whether when I will get it back. So it is very difficult option. Do you have any other option? And the provision says, yes, I have one more option. Pay additional tax 18 percentage plus 12 percentage plus 4 percentage. That is 18 plus 12 plus 4 is 18% tax, surcharge and cess. This is given in section 92 CE. So once this tax is paid, you need not show interest income any further. Okay, till this I hope you have got a clear overview. Yeah, yeah. Then, so this is a case that you have the intermediaries given you have given advance. So when the Indian company has received the loan from associated enterprise, what it will charge? It will charge the interest expense. Right, this was interest income. It will charge interest expense. The expense has to be allowed in any expense which you are incurring has to be allowed for the purpose of computation of tax, right? So here what it states that we will allow the interest to the extent of 30% of EBITDA. Okay, any excess interest will be disallowed. So for example, if, okay, the interest expense which we have booked is 150, okay, and 30% of EBITDA is 100. Okay, how much is the excess interest? 50 rupees. This will be disallowed under section 94B. Okay, then if the entity is operating in multiple countries, yeah, here we have multinational enterprise, right? So multiple countries, then it has to file certain reports, which includes master file CBC reporting, that is country by country reporting. If it is not submitted or filed, then the entity will be liable to pay prescribed penalties. Okay, then due date for filing the transfer pricing report, TP report is not the income tax return. TP report in Form 3 CEP is 31st October of the assessment year. So without any, like we don't think about any extensions. This is a given in the provisions of the Act. Okay. So that is 31st October of the assessment year. So with this, we have got an overview of what are we going to discuss in this transfer pricing section. Okay. I hope it is clear to you till now. Let's move on. Yeah, we have discussed these concepts like with respect to what is transfer pricing or how do we calculate ALP. If what if we have more than one ALP, how to arrive at that excess, and how do we do the primary adjustment, secondary adjustment? What is the provisions relating to excess money if not repatriated. Then what would the provisions if I have Indian company had received the loan from associated enterprise? What is the treatment of the interest expense? If it is operating in a multiple country, what are the reports to be filed? What if I submit or file that report? And then what is the due date of transfer pricing report? These are the key um, areas in the transfer pricing. Okay, for this we have completed the overview. Let's move on to the next step. Okay, yeah, section 92. Computation of income for international transaction with regards to ALP. ALP means arm's length price. So for which type of items we have to calculate the ALP. It could either be an income or an expense or an interest or just an allocation of cost. For all these, we have to determine the arm's length price. Okay, for income, for expense, for interest, and allocation of cost in relation to international transaction or specified domestic transaction. um, we have to calculate the arm's length price. Okay, if on applying the ALP income is reduced or loss is increased, transfer pricing provisions shall not apply. Okay, which means, so here my ALP is 100. Okay, but my sales income is 150. If I go with ALP principle, then the Indian government will lose revenue, right? That's why it says that if the income is reduced or loss is increased, transfer pricing provisions shall not apply. Okay, then transfer TP provisions are applicable when the transactions between two are associated enterprise and it is an international or specified domestic transaction and it is not an ALP. We know that it's not an ALP, so we are involved in determining the ALP. Okay, now we have transfer pricing provisions, which is given in chapter 10. Special provisions relating to avoidance of that is transfer pricing provisions. Okay, I have taken this from a journal. So what I've done is I've taken it from a journal. I've added some points and also I've taken some points from the ISMS Institute study material. I've compiled all this so that it could be easier for you to refer at once, at a one place. Okay. So yeah, let's go on. Income should arise from international transaction or specified domestic transaction, right? For the transfer pricing provisions to be applicable, the income should arise from an international transaction or a specified domestic transaction. Okay. What is international transaction? Transaction between two or more associated enterprise. Okay, enterprise we will learn it. Okay. For international transaction is transaction between two or more associated enterprise. Either or both of the associated enterprise should be non-resident. Okay, and transaction is in the nature of purchase, sale, or lease of tangible or intangible property, provision of service, lending or borrowing of money, any other transaction having the bearing on the profits, income, losses, or assets of the associated enterprise. Transaction including a mutual agreement or arrangement between two or more associated enterprise for allocation of cost or expense incurred with respect to a benefit or a service or a facility provided to any associated enterprise. So, when a transaction covered in here, it could either be a purchase, whatever transaction is there, it will be covered under between associated enterprise. It will be covered under international transaction when it is between two or more associated enterprise and either or both of the associated enterprise are non-resident. Okay. Now, we have a separate principle, like what to say, separate provision. We'll go into that also. Transaction between an enterprise and an unrelated person shall be deemed to be a transaction between an associated enterprise. You say that we both are not related at all. Why are you bringing the concept of associated enterprise? It is stating that if these conditions are fulfilled, you will be treated as a transaction between the associated enterprise. When there is a prior agreement between unrelated party and associated enterprise and transactions terms are determined by the associated enterprise. Okay, let's have an example to learn it. Okay, this is given by the ASM itself. Okay, so A Limited is there. Mr. B is an unrelated party. Okay, and C Inc. as an associated enterprise of A Limited. What happens is that on 35, the associated enterprise enters into an agreement with B for sale of product X. Okay, and then this B is going to sell goods to C. Okay, on 616, what happens is A Limited enters into an agreement to sell goods to B. It is nothing but it is indirectly selling goods to C, and in order to escape from the provision of transfer pricing, it is routing it via B. So, transaction between A Limited and B Limited is deemed to be an international transaction between the associated enterprise, whether or not Mr. B is a non-resident. So, we don't consider whether it is a non-resident or non-resident. Whenever unrelated parties use as a medium or intermediary to complete the transaction between an entity in India and that's associated enterprise, then such transaction be deemed to be an international transaction between the associated enterprise and the transfer pricing provisions will be applicable. Okay, it's clear? Yeah. So here, the associate enterprise either one or both should be non-resident to apply transfer pricing. So if both are non-resident, you may ask why Indian transfer pricing provision should be applicable. So it answers that Indian transfer pricing provisions will apply only if the income of at least one non-resident, that is one non-resident associate enterprise, is taxable in India. Okay, it may have place of business in India, something, okay, or it is deemed to be accrued or raised in India, so whatever it may be. So one non-resident's income is taxable in India, then only Indian transfer pricing provisions will be applicable. So now we have some understanding of what is the international transaction. So let's move on to specified domestic transaction. Give me a minute, let me find it out. Specified domestic transaction. Specified domestic transaction. Section 92BA provides the meaning of specified domestic transaction. As per Section 92BA, for the purpose of Section 92, 92C, and 92D, 92E, in case of a SSC, specified domestic transaction shall mean any of the following, which means either or conditions. Okay, any of the following transactions not being an international transaction, namely what are transaction? Any transaction referred to in section 80IA, inter-unit transfer of goods or services by an undertaking or unit or an enterprise or eligible business to other business carried on by the agency for a consideration not corresponding to the market value on the date of transfer. So, if some transactions being covered under 80A, which deals with inter-unit transfer of goods or services. Okay, I have a branch, I'm going to transfer between each of them, for example. Okay, yeah, and the consideration which I'm charging is not equal to the or not corresponding to the market value on the date of transfer. Okay, so on date of transfer, say assume the market value is rupees 100, I am transferring the goods at rupees 30. So then this transfer will be covered under specified domestic transaction. We have overall consideration limit. For example, for now you understand this basic. Okay, then any transfer of goods or services referred to in section 80IA 8 is inter-unit transfer of goods between eligible business and other business. Eligible business is those units which are uh, having the reduction under section 80IA. Okay, so those will be known as eligible business and other business where the consideration of for transfer does not correspond with the market value. Same for 80IA, some entity is going to charge accept the deduction, then such entity should transfer the goods to other entity in a consideration which is corresponding with the market value. What happens is that in this case 80IA we have reduction, that entire profit will be free from tax, that's exempt from tax. Okay, what happens is that the company will boost the sales here and reduce the expense. Okay, boost the sales here and reduce the expense. So that it will charge a higher consideration or less expense. So the consideration for the transfer will not be corresponding to its market value. Then, any business transacted between the SSC carrying on the eligible business and other person referred to in section 80IA. Same 80IA. Then, say I have to 610 EA. So these all are deductions which are applicable to any enterprise where the tax is entirely exempt. Okay, on it is provided as a deduction. So what happens is that it will increase the income in that particular entity. That's why the government has brought in this provision where it could restrict the this type of non-legal transactions. This is illegal transactions. Any business transacted between a company opting section 115 BAB and a person with whom it has close connection or any other transaction as may be prescribed. So all these six will be covered as a specified domestic transaction. Generally, to just to remember all the sections which gives a deduction. Okay, if the company is claiming a particular deduction, then such company should be careful in determining the transaction price. It should be in the principles of arm's length price. However, the below transaction shall not be treated as specified domestic transactions in case the aggregate of such transactions entered into by the SSC in the previous year does not exceed a sum of rupees 20 crore. So if it does not exceed rupees 20 crore, then no issues. You can still continue. If it exceeds 20 crores, it will be covered within the purview of specified domestic transaction. Okay, I hope it is clear till now. We have understood both the international transaction and the specified domestic transaction. Okay, yes, yes or yes. If we have some more principles, we will learn it as we progress. Okay, wow. Now, moving on to the next one. ALP. Okay. Income to be computed having regard to the ALP. ALP means arm's length price. ALP is the price applied or proposed to be applied in a transaction between a persons other than the associate enterprise in uncontrolled conditions. Generally, what we do is we give in a small shop. What happens is if we are unknown customer, they charge the maximum retail, that's MRP. If we are known customer or regular customer, they charge the below price. Right? That's what what is the price that will be charged in an uncontrolled situation between two different persons other than a single enterprise? That is known as arm's length price. Arm's length price to be computed as per the most appropriate method among the prescribed methods. What are the prescribed methods? We have some prescribed methods like CUP, RPM, PSM, TNNM, right? Those methods. Okay, what are the factors which are involved in MA, and that is maximum approach method selection, most appropriate method selection? Okay, it could be the nature and class of international transaction. Classes of associate enterprise functions performed as its employed and risk assumed. That is FAR. Functions performed as its employed and risk assumed. Availability, coverage, and reliability of data required for application of the method. Degree of comparability between the international transaction and the uncontrolled transaction. Extent to which reliable and accurate adjustments can be made to account for difference between the international transaction and the comparable uncontrolled transaction. Nature, extent, and reliability of assumptions required to be made in application of a method. Like these are the like theory questions which can be asked in a theory question for 2 to 3 marks. Okay, if you just remember, it will be better. Okay, you need not lose that marks also. Nature and class of international transaction, classes of AEs, FAR, that is functions performed as its employed, risk assumed, availability, coverage, and reliability of data required for application of the method, degree of comparability between international transaction and uncontrolled transaction, extent to which reliable and accurate adjustments can be made to account for difference between international transaction and comparable uncontrolled transaction. Nature, extent, and reliability of assumptions required to be made in application of a method. Okay, by this we have determined most appropriate method. Is more than one price determined by most appropriate method? If it is yes. If it is no, then what is the price? Okay, only one price is determined. Okay, then that so and so price will be known as arm's length price. That so and so price will be known as arm's length price. You say, yes, I have to determine more than one price. What should I do now? So then it says that whether the MAM selected is cup, RPM, CPM, or TNM. Okay, cup, RPM, CPM, or TNM. Okay, you say it is yes. Say it is a no. If you say it is a no, it says that you can just do arithmetic mean. Don't worry, just do arithmetic mean and complete it. Okay, you say I am very happy, and just do the arithmetic mean and complete it. Okay. So which method is not here? It is the profit sharing method is not there. Okay, you have to be very careful. If profit sharing method is used, arithmetic mean cannot be used. Okay, that's one thing which you have to be very conscious about. So whether the most appropriate method selected is RPM, CPM, or TNM. If it is one of these four methods, then you can just I'm sorry. If profit sharing method is used, only arithmetic mean can be selected. Okay, range cannot be selected. Sorry. Okay. So values including in the datasets would be the LP. Does the dataset have more than six or more entries? You have selected one of these four methods and you have six or more entries. Okay, then a range concept will be applied. When it's less than six, then it will be arithmetic mean. Okay, so what's the conclusion here? Let me repeat once again. Whether the most appropriate method selected is cup, RPM, CPM, or TNM. Okay, you say it is an S. Okay, if you say it is a no, what is that? It could either be the other method or profit sharing method. In case of profit sharing method, range concept will not be applied. Okay, it will be arithmetic mean always. It will be arithmetic mean always. Okay, if it is one of these four methods, you just again ask the question whether you have six or more entries. It says yes. Then you have to use range concept. If it says no, then you have to go with arithmetic mean. Whenever the arm's length price so determined as the values of arm's length price is less than 6, then you can use arithmetic mean, the simple one. Okay, if it is more than 6, you have multiple arm's length price, then you have to use the range concept. Range concept to be applied, that is arm's length price range starting from 35th percentile of the dataset to 65th percentile of the dataset to be constructed. Okay, 35th percentage to 65th percentage. Okay, what you do is now you have seven data. Okay, you have seven seven different arms length price. Okay, now what you do is you put 7 into 35 7 into 35 percentage, which is 2.45. Okay, and then 7 into 65 percentage, it is 4.55. You have to choose. It is not a whole number, right? You have to choose the next number. So you have to choose from third to fifth, third value to fifth value, third value to fifth value. Okay, if it is a whole number, that number and next number, mean of that number and next number. Okay, assume it is okay, assume it is a whole number, then you have to consider the mean of that number and the next number. Okay, then if the transaction price is within the range, the same will be determined as a ALP. So you have a range between 100 to 150. Okay, now the transaction price which you have entered is 120. Okay, then such transaction price will be considered as, that will be deemed to be the ALP. Okay, you have a range of 100 to 150, but the transaction price is 110. Oh, sorry, it is 90. You have the range of 100 to 150 and the transaction price is 90. Then the ALP would be the median of the data set. Median of the data set. Median means what? Mid value. Median means mid value. Mid value of the data set. Okay. You then ask if there is only 1% difference. Should I also do it again? Then the principle states that if the difference between the ALP and the actual transaction price is up to 3% and 1% in the case of wholesale trading, the actual transaction price, then ALP determined shall be ignored. For example, I have the transaction price as 99. I've just given an offer of saying 99. But the arm's length price is 100 to 150. The difference is what? Assume, okay, see, assume here what happens is I have the transaction price is 99 and the arm's length price is to be determined at 100. Okay, that's the arm's length price. What happens is that Is there a big difference? No. So I asked, why should I do the hamstring price? So it gives us a benefit like if the difference is within 1%, it's 1%, right? Or within 3% in a case of generally and 1% in the case of wholesale trading, then the actual transaction price can be read as ALP and the ALP sold amount can be ignored. Okay. I hope till this it is clear. So let's move on to the next one, right? Yes or yes? Yes. Okay. Yeah. Associated enterprise. What do we mean by it? We said that we have so many conditions in it, right? So associated enterprise. An enterprise which participates directly or indirectly through one or more intermediaries in management of the other enterprise, control of other enterprise, or the capital of other enterprise. Very clear, right? It's very easy to understand, right? So, for example, when A Limited directly control participates in the management of B Limited and B Limited directly participates in the management of C Limited. A Limited directly participates in the management of B Limited and B Limited directly participates in the management of C Limited. In such situation, A Limited has a directly participating in the management of but has an indirect participation in the C Limited because it controls through one or more enterprise. Okay, it controls C Limited via B Limited. In such scenarios, both B Limited and C Limited would be known as associated enterprise. Okay, yeah. If one or more persons participate directly or indirectly through one or more intermediaries, the management, control, and capital of two different entities, those two different entities will be known as associated entities. Let's have an example. Mr. A directly has a control in A Limited and B Limited. In such a scenario, both A Limited and B Limited are associated enterprise since they have a common person, Mr. A, who controls both A entities, A Limited and B Limited. Then we have deemed associate enterprise. First condition is substantial voting power. Substantial. Okay. One enterprise holds 26% or more of the voting power directly or indirectly in other enterprise. So if one enterprise holds 26%, substantial here would mean 26 or more. Why it is substantial? Let me explain you. Okay. For an ordinary resolution, we need 51%, right? And for special resolution, it was 75%. So I can't pass a special resolution without this party's support. Okay. If he rejects, special resolution will not be passed, right? I will have only 74% because he has 26%. He has to support the special resolution. That's why he has a substantial voting power. In the cases where it is so necessary for his approval, then it is substantial voting power. A limited holds 33% of voting power and B limited. B limited holds 80% of voting power and C limited. A limited has 33% and B limited has 80%. Above situation, A limited holds more than 26% in B limited directly and indirectly in C limited. Okay, indirectly in C limited. That is 80 percentage into 33 percentage is 26.4. It's again beyond, right? 26%. So therefore, it directly controls B limited and indirectly controls C limited via B limited. That's why both B and C limited are associated enterprise of A limited. Yes, now clear then. Substantial voting power in two entities by a common person. Any person holds 26% or more of voting power directly or indirectly in two different entities. It's A limited holds 40% of shareholding in both X limited and Y limited. Both is beyond 26%. Where neither X has limited has any shareholding, but X limited does not hold anything and Y limited does not hold anything as X limited. But both are both both X and Y limited will be deemed to be an associated enterprise in this case because A limited Mr. A has a been a substantial shareholder in both the enterprises, then advancing of substantial sum of money. If one enterprise advances loan to the other enterprise of an amount 51% or more of the book value of the total okay, here it is book value, not the market value, book value. So be clear in it, okay? Whenever you read something, be clear of what you read. Okay, if you read something, okay, you did not cover 100% questions, okay, but if you cover 75%, be clear of what you have read. Okay? That's what most important CA final. Okay, book value of total assets of Y limited is 100 crores. X limited advances loan of rupees 60 crores to Y limited. Since in this case, X limited advances loan of by which is 60% of the book value of the total assets. Total assets is 100 crore. Why X Limited has advanced 60 crores with 60 percentage, therefore it is advancing some of substantial sum of money, therefore it is deemed to be an associated enterprise. Then guaranteeing borrowings. In case of advancing, it is 51 percentage. In case of guarantee, it is only 10 percentage or more of the total borrowings of the city. It is not the other. It is the borrowing. I have borrowed rupees 1 million, okay, and out of which 20 percentage is guaranteed by A Limited. Then A Limited and P Inc. will be deemed to be the associated enterprises. Then appointment of majority directors of other entities. One enterprise appoints more than half of the board of directors. Then, okay, like X Limited has 15 directors. Out of that, Y Limited has appointed 8 directors. Then X and Y Limited will be deemed to be the associated enterprises. Then appointment of majority directors of two different entities, enterprises by same person. More than one half the directors or members, okay, is appointed by the each of the directors are appointed by the same person. Mr. A appoints 9 directors out of 15 directors in X Limited and 2 directors on the board of Y Limited. In such a case, since A is a common person, okay, and he appoints more than one half of the directors and appoint two EDs. ED is executive director. Okay, one or more executive director. Okay, he should appoint. Okay, or he should appoint one half of the board of directors or one or more executive directors. Here he have appointed two directors. Okay, therefore, it is both X Limited and Y Limited be deemed to be associated enterprises. Then dependence on intangibles with respect to which other enterprise have exclusive rights. The manufacture or processing of goods or articles or business carried out by one enterprise is wholly dependent on the know-how, patents, copyrights, etc., or any data documentation, drawing, or specification relating to the patent, invention, model, etc., of which other enterprise is the owner or in respect of which other enterprise has the exclusive right. For example, I'm keeping some sandwich shop, okay, or some burger shop, okay, and I'm obtaining the franchisee from McDonald's, McD, okay. There, therefore, the 100% of the patent copyright is owned by the other enterprise. Therefore, my entity and the McD will be known as associated enterprise. Dependence on raw materials applied by the other enterprise. Okay, here we have one more condition. See, this condition very keen. Okay, uh, 90% or more of the raw materials and consumables required for the manufacture or processing of goods or articles business carried out by one enterprise is supplied by the other enterprise. You will think that 90% is given only 90% or more, then it is associated enterprise. No, please read the full condition. Or by such a specified person by the other entity where the price or other conditions related to supply are influenced by the other entity. Supplier has to influence the conditions, terms and conditions. Then only this will be known as associated enterprise. Okay, 90% or more of the raw materials and consumables required for the manufacture or processing of articles or a business carried out by one enterprise are supplied by the other entity, and the price and conditions related to supply also influence the other entity. Then only it will be treated as associated enterprise. Okay, dependence on sale. The goods or articles manufactured or processed by one enterprise are sold to other enterprise or to persons specified by other enterprise, and the price or other conditions relating to the are to influence by the other enterprise. Here, what happens? Earlier it was supplier, other entity was supplier. Now, other entity is a buyer. Okay. Here also the buyer has the right to determine the terms and conditions. So then it will also be known as associated enterprise. Controlled by common individual. Where one enterprise is controlled by an individual, the other enterprise is also controlled by such individual or his relative or jointly with the individual and his relative. For example, Mr. A and B are relative. A has control over X limited, B has control over Y limited, and A and B are relative, right? Therefore, X and Y limited will be deemed to be the associated enterprise. Then, next condition is that controlled by HUF or member thereof, where one enterprise controlled by the HUF and other enterprise controlled by the member or HUF or by relative of the member of the HUF or by joint member and the relative. Then, for example, HUF controls A limited. Okay, member of HUF controls B limited. Then A limited and B limited will be deemed to be the associated enterprises. Interest in a firm associated in AOPs or BOIs, where one enterprise is a firm, AOP or a BOI, the other enterprise holds 10% or more in the firm HUF or BOI. One enterprise is firm and other enterprise holds 10% or more interest in the firm, HUF or BOI. Okay, then it will be known as sustained enterprise. Mutual interest relationship. There exists between two enterprise any relationship of mutual interest. For example, I have some specific mutual interest. Both of us bear similar interest. Okay, then it will be known as associated enterprises. So, with this, the definition of associated enterprise, which we were so worrying about, has been completed. So, we'll just go over it once again so that we'll recall it. Okay. First thing is an enterprise which participates directly or indirectly or through one or more intermediaries in management of other enterprise or control of other enterprise or capital of other enterprise. Second condition is that if one or more directly or indirectly through one or more intermediaries in management of two different entities, two different control of two different entities or capital of two different entities, then those two different entities will be need to be associated enterprises. Financial voting power should be there. That is 26% of more, or directly or indirectly. Substantial voting power in two entities by a common person is holds 26% or more of the voting power directly or indirectly. Advancing of substantial sum of money, 51% or more of the book value of the total of the other enterprise is given as a loan by one entity. Guaranteeing borrowings. One entity guarantees 10% or more of total borrowings of the other enterprise. Appointment of majority of directors of other enterprise. One enterprise appoints more than one half the board of directors or members of the governing board or one or more executives, directors or executive members of the governing board of the other enterprise. Appointment of majority of directors by two different enterprises by the same person. Okay, more than one half of the directors or members of the governing board or one or more of the executive directors or members of the governing board of each of the two enterprises are appointed by the same person. The independence with respect to the intangible, where the other enterprise has the exclusive right. The manufacture or processing of a goods or articles or a business carried out by one enterprise is wholly dependent on the know-how, patents, copyrights, etc., or on any data, documentation, drawing, or specification relating to any patent, invention, model, etc., of which other enterprise is the owner or in respect of which the other enterprise has the exclusive right. Dependence on raw materials supplied by the other enterprise. 90% or more of the raw materials and consumables required for manufacture or processing of the goods or articles or a business carried out by one enterprise are supplied by the other enterprise or by persons specified by the other enterprise where the prices and other conditions leading the supply are influenced by such other enterprise. Dependence on sale. So here it is supply is influenced by other enterprise. Okay, then dependence. The goods or articles manufactured or processed by one enterprise are sold to other enterprise or to persons specified by other enterprise, and the prices and other conditions relating to thereto are influenced by such other enterprise. Then, controlled by a common individual, where one enterprise is controlled by an individual, the other enterprise is also controlled by the individual or his relative or jointly by such individual and his relatives. Then, controlled by HUF or member thereof, where one enterprise is controlled by HUF or and the other enterprise is controlled by a member of such HUF or by a relative of a member of such HUF or jointly by such member and his relative. Interest in a firm AOP or BOI, where one enterprise is a firm AOP or BOI, the other enterprise holds 10% or more interest in the firm HUF or BOI. The mutual interest relationship. There exists between the two enterprises any relationship of mutual interest as may be prescribed. So with this, we are now clear with the definition of associate enterprise. Whichever entity will cover under associate enterprise, we are now clear. So one part of the definition of transfer pricing, we are now clear. Okay. Also, we are clear with what is international transaction and specific domestic transaction. So what is now needed is how do we compute? What is the amount of arm's length price? That is what it is pending, right? So method of computing arm's length price. It is given under section 92C. Okay. So it is given as most appropriate method, right? Most appropriate method should be right. Most appropriate, most means it should be the top most. There is only one could be there. So if we ask a question, can two methods be appropriate? No. The answer will be generally no. Only one method can be the most appropriate. Best means only one, right? Like that. Only one method can be the most appropriate. So out of these, we have to choose only one method. Okay. So which is nothing but comparable uncontrolled price method. This method is applied where similar transaction between unconnected parties. Whenever we have a similar transaction between the unconnected parties, this method could be applied. Identify the price in the comparable uncontrolled transaction. Comparable uncontrolled transaction. We have to identify the price, which we are going to charge. Adjust the price for material difference in terms of contract, credit, transport, etc. Okay, what happens is that for a similar party, yes, it's only in India, so I have to transfer by way of what land. So the transfer charge will be with that rate. Okay, I have to have charged the unsent price with that. Okay, but for my affiliate transfer by way of sea, so a similar adjustment have to be made for transport, or else for that customer, I am going to bear the transfer price. So I would have included it in my cost and charged the margin of that, right? But for my associate enterprise, he is going to take over the transport. Okay, um, my obligation is to just to deliver the goods at the port. Okay, beyond that, he will take care. Therefore, the transport cost will not be added in the price. So the adjustment has to be made. Okay, or else I'm going to give the credit of 2 months for the normal customer and 3 months for the associate enterprise. So that credit, the interest has also to be adjusted for. So adjusted price is the arm's length price. For now, understand the concept. We'll solve some, like we will get to know how the procedure is to be done. Okay. I hope this is clear. So we'll just revise. Cup method. This method is applied where there are similar transactions between unconnected parties. Identify the price in a comparable uncontrolled transaction. Adjust the same for material difference in terms of contract, credit, transport, etc. Just that price is be known as arm's length price. Then we have the retail price method. This method is applied where an item obtained from associated enterprise is resold to an unrelated party. What I do is I get some goods from associated enterprise, I sell it to the customer. Okay, what I'm going to do is this is scenario. I purchase some goods from Asuri Enterprise and I resale it to the unrelated party. The principle says that identify the resale price at which the item is sold to the unrelated party. What is the price you are going to charge to the unrelated party? Whereas you are going to charge the revenue to the unrelated party. You say that is 100 rupees. Then reduce the resale price by the normal gross profit method on comparable uncontrolled transaction and expenses and custom duty with respect to purchase. Okay, we have to reduce these. If I reduce those, I get a price at rupees 70. So adjust the price for functional or other differences materially affecting the gross profit margin in the open market. Whenever there is something like exchange difference could be there, those have to be adjusted. Adjusted price is known as arm's length price. Adjusted price would be known as arm's length price. Let's revise the principle again. Identify the resale price at which the item is sold to a related party. Reduce the resale price by the normal gross profit margin on comparable uncontrolled transaction and expenses incurred as customs duty with respect to the purchase. Adjust the price for functional or other differences materially affecting the gross profit margin in the open market. Adjusted price would be known as ALP. Then we have third method, which is cost plus method. This is simple method, right? This method is generally applied where semi-finished goods are sold to AE. Semi-finished goods, if I'm going to sell it to AE, then this cost plus method will be applied. There, I will identify the direct and indirect cost of production incurred for the property, transport, or service provided to AE. So I'm going to transfer something to AE. So I will know the cost. So I have to identify it. Then determine the normal gross profit markup to such cost by unrelated enterprise in comparable uncontrolled transaction. Whatever GP margin is high, half. Okay. I have to determine it. Then adjust the normal GP markup for functional other differences. If there is any functional exchange difference, so which is materially affecting the GP markup in open market, then I have to adjust the same. Total cost increased by the adjusted markup would be known as the ALP. Total cost plus the adjusted margin, that is adjusted gross profit margin, will be known as ALP. It's under cost plus method. Let's recall it again. This method is generally applied where semi-finished goods are sold to associated enterprise. Identify direct and indirect cost of production incurred for transfer of property or services provided to associated enterprise. Determine normal GP markup to such cost by unrated enterprise in comparable uncontrolled transaction. Adjust the normal GP markup for functional or other difference materially affecting the GP markup in open market. Total cost increased by adjusted markup would result in arm's length price. Now, we have the fourth method, profit split method. This is the only method where a range concept will not be applicable. This method is applied where there is a transfer of unique intangibles or in multiple international transactions. Unique intangibles is being transferred or there is multiple international transaction. Determine the combined net profit of associate enterprise arising out of international transaction. So I am not sure of what is the exact amount. So I just take the extreme customer and extreme input price and just find the net profit of the associate enterprise arising out of transaction. Evaluate the relating contribution of each enterprise to the earning of the combined NP on the basis of FAR. FAR means what? We have read it there, right? Functions performed, assets employed, and risk assumed. Functions performed, assets employed, and risk assumed. So based on this, we have to bifurcate the net profit and allocate to each associated enterprise. Split the combined net profit among the enterprise in proportion of market returns, individual profits in proportion to the relative contribution. Okay, then ALP to be determined on the basis of the profit portion. So cost plus this profit portion will be forming part of the ALP. Okay. Profit split method. This method is applied where there is a unique intangible which is being transferred or multiple international transactions are there. Okay. Determine combined net profit of associate enterprise arising of international transaction. Evaluate the relative contribution of each enterprise to the earning of the combined net profit on the basis of FAR, that is functions performed as employed and risk assumed. Then, split the combined net profit among the enterprises in proportion to the market returns or residual profits in proportion to their relative contribution. ALP to be determined on the basis of the profit so apportion. Okay. Now we have the last method, which is transactional net margin method. Compute the net margin of the enterprise from the international transaction with having regard to the cost incurred, sales affected, and assets employed. We have to compute the net profit margin. We have in early method we computed the gross profit margin, right? Here we have to compute the net profit margin. Compute the net profit realized by the enterprise or unrelated party in uncontrolled comparable uncontrolled transaction applying the same base. We have to compute the net margin for the uncontrolled transaction. So I'll just the net margin realized from comparable uncontrolled transaction to account for differences affecting the NP margin in the open market. Compare the net profit margin related to the cost, sales, assets of your enterprise with the net profit margin of uncontrolled party and adjusted NP taken to account to arrive at ALP. Okay, this could be quite like confusing. You will understand when the steps are being done. Okay, compute the net profit margin of the enterprise from international transaction with AE. Having regard, okay, first we have to compute what is the AE's net profit margin in this international transaction. Then, second step is that you have to compute the net profit margin for similar uncontrolled transaction. Okay, then you have to check and adjust for if there is difference, like we have given different credits or we have given different transport costs or different contracts is there, so that differences have to be adjusted. Different functional differences are there, we have to adjust all those. Okay, then we have to compare the net profit margin related to cost, sales. We have to compare it as a percentage. Okay, like percentage this as a percentage of sales or cost or assets. Okay, and then this percentage will be directly applied to the arrive at ALP. These are the five methods, and these are the cases. We have to. These are the cases. Like when this method have to be applied, these are the cases where the particular method had to be applied. For example, okay, whenever it is a cup method, we have to apply when there are similar transactions between the unconnected persons. There are similar transactions between unconnected persons. And the resale price method have to be applied when the item being obtained from associated enterprise is being resold to the unrelated party. Cost method will be applied. This method is generally applied where semi-finished goods are sold to the associated enterprises. Profit split method will be applied when there is a transfer of unique intangible or there are multiple international transactions. Transaction net margin method will be applied when we don't have any other method, and it's a residual method kind of where we compare the net margin. Okay. I hope till this the principles are clear. Let me now move to the computation part. Okay. In the case of cup method, price charged by the independent party, we have to take it as a base, add it for any other functional differences like warranty, discount, CIF, FOB. Like warranty, I could give them 6 months warranty, but I'm giving the other, I mean, unrelated party 1 year warranty. So this warranty have to be adjusted to arrive at arm's length price. Then resale price method. Resale price charged to unbilled party less the gross profit margin, normal gross profit margin, less the expense on purchase of goods will arrive at arm's length price. Then we have the cost plus method where it is a direct cost plus indirect cost of production and the normal GP margin on similar circumstances less adjustment for any other functional differences in the gross profit margin. We arrive at the arm's length price. Okay, and then profit split method. Calculate the profit of the total group or joint venture and then divide it in the ratio of FAI, that is function performed, assets employed, and the risk assumed by the enterprises. If you compute the entire group's profit and then allocate the profit based on the FAR. Then transaction net margin method. Net profit charged by other enterprises in similar uncontrolled transactions computed and applied to the compute ALP subject to the functional differences between the international transaction and comparable uncontrolled transaction. That is what we have done, right? We have taken the net profit of an uncontrolled transaction, net profit of the associated enterprise transaction, then we have adjusted for any functional differences, then we are applied it to the base like percentage of sales or percentage of cost or percentage of asset, and then such percentage is added to the to find the normal the arm's length price. Okay, now we have been given a guidance. Okay, how to compute the weighted average of the price in these three circumstances. When it's a resale price method, the weights are assigned to the quantum of sales which are considered for the respective prices. In the resale price method, the weights are assumed to the, assigned to the quantum of sales. Then cost plus method, weights are assumed to assigned to the quantum of cost. Weights are assigned to the quantum of cost. Transaction net margin method, by assigning weights to the quantum of cost incurred or sales affected or as employed or to be employed or as the case may be or any other base which has been considered for arriving the respective price. Here it has been given like this is a residual method kind of thing, right? So whichever you take a proper base. Okay, with that base we can assign the weight. Okay, for resale price method, it is the resale price, that is sales, which is given to be the weight, and then cost plus method, it is the cost which is assigned the weight. Okay, with this we are also clear with the methods. So this is what is expected for the exam. Okay, but there are some untapped areas also which should also be discussed, and interest have to be discussed, primary secondary adjustments have to be discussed. Okay, that those are already asked, but there are some untapped areas. We'll also discuss it. Okay, now moving on. The assessing officer may invoke the power to determine the answering price. We have said right. If he has an opinion, when the assessing officer has the power to exercise, he has the power to exercise to invoke the and determine the ALP if during the course of any proceedings of the opinion that on the basis of material or information or document, he cannot do it as just like that. Okay, he has to support it on the basis of material or information or documents MID. In this position, the price charged or paid in an international transaction has not been determined. Has not been determined. Thus, we have not followed the principles of transfer pricings, or any information and documents related to the international transaction has not been kept or maintained. I don't have a proper supporting evidence to justify that this has been determined in accordance with ALP principles. The information or data used in computation of ALP is not reliable. The data itself is not reliable. Then how can we rely on the results, right? SSC has failed to furnish the data with a specified time, any information of documents which he was required to be furnished by a notice. The SSC officer has sent a notice seeking for the documents and information. Okay, the SSC has failed to summon the documents with a specified time. Then, in these four situations, the assessing officer has the power to invoke and determine the arm's length price. So, what are the four situations? The price charged or paid in an international transaction has not been determined in accordance with sections. Okay, Then, any information or and documents relating to an international transaction has not been kept and maintained by the SSC in accordance with the provisions contained in this section or rules made thereunder. Then, the information or data used in the computation of arm's length price is not reliable or correct. The SSC has failed to furnish within a specified time any information or documents which he was required to furnish by a notice issued under Section 92D. Before invoking the power to determine the arm's length price, an opportunity of being heard. There is ROBH, right? Reasonable opportunity of being heard is to be given. So whenever something is being done, which is not favorable to SSC, the government or the law states that reasonable opportunity of being heard should be given. Reasonable opportunity of being heard is that I have to give a notice that I am finding this as an issue. Do you think is there anything which I must like something that notice is being asked? Okay, then. So yeah, now that the assessing officer determined the arm's length price, okay, it is determined now as 150. Okay, the actual sale price is 100, and now I have increased the income by 50. Now the provision states that the deduction under section 10AA and chapter 6A shall not be allowed for the additional income computed by him. What now my SC asks is 8A deduction is there. So entire profit will be exempt. So what he says that, okay, now you have increased the MI income by 50. So you have to provide a deduction again for 50. The law clearly states that for such addition, no additional deductions will be provided. With no reduction in section 10AA or chapter 6A will not be allowed on the additional income computed by him. So the additional 50 has to pay the tax. Okay. Then also when the total income of associated enterprise is computed under this section on the determination of ALP paid to the associated enterprise for which tax has been deducted or deductible at source, the income of the associated enterprise shall not be recomputed. That is, the other party cannot claim the refund of TDS. Okay, what happens is that I in India. Okay, for India, what I have to do? The first example, what we discussed, we have to increase the expense in India. Okay, so what I have done is I have shown the expense as rupees 100. Okay, and the other party has deducted the TDS at rupees 100. Okay, as in the TDS rate is 10%. For ease of understanding, let's assume the TDS rate is rupees, I mean, is 10% and this is rupees 10. Okay, 100 rupees is income, as 100 rupees is my expense tab book, and that 100 it has been received from the associate enterprise. Therefore, it has deducted the TDS at the rate of 10%, which is rupees 10. Okay, now the SC officer comes into picture and he says that this is not an arm's length price. The actual amount arm's length price of the expense is rupees 70. Okay, he puts it as 70. Okay, now what would have been the TDS which has been deducted in the 70? It should be rupees 7, but I have over deducted the TDS by rupees 10. Now my SC is asking to refund the rupees 3. The law says that no refund will be provided to you. Get out. Okay, that is whenever the expense is reduced for the purpose of based on the determination of ALP, then the TDS will not be affected by it. Okay, you cannot claim the refund on the TDS. Okay, that's what it has been told. Okay, like I had a 100 rupees income on which 10 rupees has been added as tax. Then the asking also comes into picture. It determines the ALP of that expense as rupees 70. So I'm asking the refund of rupees 3 because TDS should be 7 rupees only, right? So the refund I'm asking for rupees 3, and the AO says, get out, I will not provide you any refund of that TDS. Okay, that's what the principal says. Now, we have another provision, right? Reference to transfer pricing officer, which is what we are going to discuss now. Okay, this is that provision. Yeah, let's go on discussing it. Reference to a transfer pricing officer. AO with the prior approval of CIT or PCIT may refer to the calculation of ALP to the transfer pricing officer. AO has to obtain the approval of the Commissioner of Income Tax or the Principal Commissioner of Income Tax. With this approval, may refer the calculation of ALP to the transfer pricing officer. Something is there. I am not very well versed in TP calculation. So what I'm doing is I'm moving the job. I'm delegating the job to the transfer pricing officer with the prior approval of the CIT or PCIT. TPO for determining the ALP may call for information or require associate to produce any evidence. He may TPO has the power now to call for any information or evidences. TPO has the power to compute the ALP of the international transaction noticed by him in the course of proceedings, even if it is not referred by AO, it is not reported by taxpayer in the transfer pricing report. So, Yes, he can. Even the transfer pricing officer can also invoke his powers and just start checking whether it is an arm's length price. Okay, then okay, for any of the international, for some okay, now I have been referred by AO for one international transaction. Okay, the transfer pricing officer has also the power has the power to invoke any other check and check whether there are any other international transactions in the course of proceedings, even if it is not reported or not asked by the AO to check the transaction, or it is not reported by the taxpayer itself in the tax fund pricing report. For example, I'm A Limited in India. I have B Inc. and C Inc. Both are my associated enterprises. I have reported B Inc. transfer pricing in the transfer pricing report. Okay. An assessing officer has also asked the transfer pricing officer as an ALP. Okay. Now the transfer pricing officer has the power to check the records and evidences of and to find whether that transactions which have entered into with C Inc. It's also an associate enterprise is in the arm's length price. This is what the principle states. Okay. The order of transfer pricing officer shall be binding with the assisting officer. He cannot say he has referred to it, and once it is say assume the income computed by SSC is 100. Okay. The transfer pricing officer says it is 120. Assisting officer says it's 150. Okay. Now, the officer cannot say your report is wrong, so I'm going with 150. He cannot say that. Whenever transfer pricing officer is appointed and he passes an order, such order is binding on the SSC as well as on the assisting officer. On the basis of the material and evidence, transfer pricing officer shall compute the ALP and pass an order computing the ALP before 60 days prior to the last date of computation of assessment allowed in the section 153 and 153B. Okay, where any case is referred to TPO, then the time limit allowed in section 153 and 153B shall be increased by 1 year. Whenever TPO is involved, time limit for assessment will be increased by 1 year, and from that date before prior to 60 days, the TPO should pass an order and submit his computations. Okay, this is what reference to TPO and section 92 CA is all about. Okay, now moving on to the next question, next part. Section 92D. In case where the aggregate value of transaction does not exceed rupees 1 crore, it is not obligatory for the SSC to maintain information and documents. What does 92D states? It states that some information and records are to be maintained. Okay, for those transactions that are international. Okay, either it is with the associated enterprise or so if any party, if the international transaction is beyond 1 crore, I have to maintain some documents and records. Okay, that's what this principle states. There's some other principle which states that for any transaction with the associated enterprise, I have to maintain proper records and documents to substantiate that this is in accordance with the ALP principles. So let's break into two. When the international transactions are with associated enterprise, so let's break it into what is that is. Okay, let me have it. Yeah. When I don't know what happened. Just give me a minute. Okay. So let me dictate it. Okay. I don't know what happened. Just or else give me a minute. One more minute. Let me check it out. Okay. I now I understood what happened is. Okay. Now for section 92, for the purpose of section 92D, we have to calculate as two things. Okay. One is when international transaction is with associated enterprise, then we have to maintain records even if the value is less than rupees 1 crore. When the international transaction is with other related parties, then it is enough if we maintain records for those transactions, records when the value exceeds rupees 1 crore. This is what the underlying thing is. Okay, so let me make it very clear here. Yeah, copy this once. Like when international transaction is with associated enterprise, we have to maintain records even if the value is less than rupees 1 crore. When the international transaction is with other unrelated parties, then it's enough if you maintain the records under section 192D when the value exceeds rupees 1 crore. I hope this is clear till now. Yeah. So now we can move on to the next one. The above information and documents The amount of information and documents are required to be maintained for the period of 8 years. This could be an MCQ. For a period of 8 years from the end of the relevant assessment year. AO or Commercial Appeal is empowered to require persons entering into an international transaction to furnish prescribed documents and information within a period of 30 days from the date of receipt of such notice in this regard. Constituent entity is required to keep and maintain the information and document irrespective of fact whether or not international transactions are undertaken by such constituent entity. So constituent entity, he has to keep the records irrespective of the fact whether any international transaction is being entered or not. Okay. Now we have a doubt. What is a constituent entity, right? Yeah. Constituent entity. Constituent entity here, I have it in the page number 11. Constituent entity, any separate entity of an international group that is included in the consolidated financial statement of said group for financial reporting purpose or may be so included for said purpose if the equity share of the entity of the international group were listed on a stock exchange. Any entity that is excluded from the consolidated financial statement of the international group solely on the basis of size or the materiality, any permanent establishment or separate business entity of the international group, included in clause 1 or 2, subclause 1 or 2, if such a business unit prepares a separate financial statement for such permanent establishment for financial reporting, regulatory, tax reporting, or international management, which means that when if it is a part of a group which is having an international transaction, then it has to maintain the records. It's simple. Okay, so simple as that. Okay, yeah. Then we have information to be kept and maintained under section 92 D, which is as per rule 10D. Okay, I will mark it as read only. Okay, which means you need not memorize this concept. If at all it is asked, it is for 3 to 5 marks. You can just go over it once, plus, but don't miss to go over it. Okay, you can just go over it. Which is like you have to describe the ownership and structure, then profile of the multinational group, and then broad description of the business, nature and terms of the international transactions being entered into, description of the FAR, that's functions performed, risk assumed, and assets employed, record of the economic and market analysis, forecasts and budgets, record of uncontrolled transactions taken into account for the comparability. What are the transactions have been taken as uncontrolled transactions? Then record of analysis performed to evaluate the comparability. Then description of the methods used, record of actual working carried out. What is the record supporting the transfer pricing? Then assumption, policies, and price negotiation, if any, which have been critically affecting the price. Details of adjustments, if any, made to the transfer pricing to make in line with the arm's length price in accordance with the income tax rules, then any other information or data. Okay, so the 13 things which are required to be maintained in section 92D. So this is one time, there is a read only. Okay, now information to be supported by authentic documents. Authentic is like which has to be genuine documents, official publications. Okay, these documents include official publications. Also a one time, there is read only. This also read only. Just you have to read it once at least. You have to read it once at least. Okay. Reports of market research carried out, then price publications in stock exchange or commodity market quotations, price published accounts and other financial statements, agreements and contracts entered into associated enterprise, letters and other corresponding documenting any terms negotiated. Documents normally issued in connection with the various transactions under accounting practices followed. It's also provided that information and documents should be maintained at the specified later should be specified date. Specified date is nothing but 31st October. For transfer pricing chapters, the transfer pricing report or any other specified date would mean 31st October generally. Okay, generally it is 31st October. Okay, so it has to be maintained at the latest. I should not maintain the 5 years past data now. Okay, it has to be the latest one. In the case international participants continue to have an effect for more than one financial year, the fresh documents will not be required. But if there is no significant change, then fresh documents will not be required. The past documents will be sufficient. Okay, now then now penalty. We'll just discuss all the penalties once, and then we will move on to the next one. Okay. after a break. Yeah. We'll complete the penalty and then go on for a break. Penalty for failure to comply with the transfer pricing provisions. Section 270A9 states a failure to report any international transaction or deemed international transaction to which provisions of Chapter 10 would apply as misreporting of income. I am misreporting the income. Then 200 percentage of the tax payable on such underreported income. 200 percentage will be paid as penalty. Tax payable will be paid as penalty. Then, that is, which means that I have to pay the tax, then I have to pay additional 200 percentage. It's approximately 300 percentage of the tax payable. Then, yeah, totally right. 100% is tax, then 200% is penalty, then totally will be 300% of amount. 271BA. Failure to furnish a report of account, that is a transfer pricing report, then it is rupees 1 lakh. Then it is rupees 1 lakh. 271G. Failure to furnish any info or that's information or document as required by the assessing officer within 30 days of the receipt of notice or extended period not exceeding 30 days. So I'm giving a 30 days period. Maybe the extension could be for another 30 days within 60 days. On maximum will be 60 days. Then it is 2% of the value of the international transaction for each failure. All these could be asked in MCQ. Okay, or one question can be asked asking us to compute the penalty in all the 5 cases. You have to ensure that you remember at least what you learn. Okay, then 271A, failure to keep or maintain any such document or require failure to report or failure to maintain or furnishing any incorrect information, that is 2% of the value of each international transaction. Okay, then 271AA is not, it's an addition and not a substitution of 271BA. That is, I'm not substituting the report, I'm also not keeping the books of accounts, that is records and documents. Then 271BA and AA are two different penalties and both are to be paid. Okay, it's not that I will pay one and I will no, you need not pay the other. It's not like that. It's an addition and not substitution. This could be a question MCQ. 271AA is an addition and not a substitution of penalty 271BA. The SSC proves that there was a reasonable cause of failure, no penalty will be leviable. Okay, if there is a reasonable cause, like some market crash happened or there's a fire accident which happened on the last 15 days. So it is a reasonable cause for failure. Then I've also have submitted within the next 10 days. Once I get the records, then I have a reasonable cause for failure, right? So then penalty will not be levied. Okay. Penalty for non-furnishing of report by any reporting entity which is obligated to furnish a report, which is like master file and the CBC reporting, which we are going to discuss. But the penalty alone we will discuss here. If it is not more than 1 month, then from the due date, then 5,000 per day. Beyond 1 month, 15,000 per day. Continuing default even after service of order, that's order I have serviced. Okay, then 50,000 per day, beginning from the date of service of order. It is for 5,000 for 1 month. Beyond 1 month, from the end of first month, I have to pay 15,000 per day. Once notice is served, from the date of notice of service of notice, I have to pay 50,000 penalty. Penalty for failure to produce information or documents in prescribed time. I'm not producing in prescribed time the documents. Then what's that? 5,000 per day for funding failure, and then 50,000 per day beyond service of order. 5,000 is general penalty. Okay. Then I have one more penalty which is discussed here. Okay, here. Penalty for submission of inaccurate information in CBC report. If the reporting entity has provided any inaccurate information in the report, the penalty would be 5 lakhs is the highest penalty, right? Which in amount, monetary amount, if we discuss is the highest penalty, right? 2% is there, that's percentile, correct. Then 5 lakhs, if the entity has a knowledge of inaccuracy, it is the known inaccuracy. It's like fraud, right? I know it, but I didn't inform you. Okay. The entity discussed inaccuracy after the report is furnished and fails to inform. Even after the report is furnished, I know that I have found that there is an inaccuracy, but I have not informed the authority. The entity by itself furnished the inaccurate information on a document in response to the notice of the prescribed authority. So first time it's right report. Okay. At time of furnishing the report, I know but that I'm giving you the incorrect information, that is inaccurate information, and I have not informed you. Okay, then I have to be charged by 5 lakhs. Okay, or else I have filed the report without knowing that is inaccurate information. Later I discovered that there is inaccurate information. Even then I have not informed you. Then a period of 15 days. I'm giving 15 days time limit here. 15 days. Okay. Within 15 days, I'm not informing you. Then I will be charged with a penalty of 5 lakhs. The third one is I have been issued a notice. Even the response to notice, I'm submitting the inaccurate information. Then I will be charged with a penalty of 5 lakhs. So with this, we'll wind up the first session. The part 2 will come. Okay. Thank you.